Love how we get inspirational and motivational here at Love how get a better mindset and set your goals here at Love how educational things you need to know here at Love how like credit, home, buying loans, and much more here at Love how the space for
Hey, everybody. It's Friday. Hello, everyone. Hello. Welcome to the Home Buyers Clubhouse, where we go live every Wednesday and every Friday. On Wednesdays, we drop something inspirational, motivational. On Fridays, we drop something educational. Y'all, look, are you ready? Are you looking to step in and take over a family member's mortgage? That's what we're talking about today. But for those of you guys who don't know me, my name is Jessie Lynn. I am a triangle realtor with A to Z Realty. Miss Erica Batts, honey, introduce yourself.
Hello. I am Erica Batts. I am your mortgage loan officer with New American Funding.
Yo, so many times I know as a realtor, I don't know about you, Erica. A lot of people, they get their families' homes. They don't know what to do with them. They call and say, "Hey, what's the step? What's the process of taking over your family's mortgage?" And a lot of the times my answer is, well, it's not so simple. How can I take over their house payments? It's not so simple. Erica, do you get that call a lot, honey? Do you get that call?
I do. Usually, when a family member maybe has passed away or something like that, or if they get into financial trouble, then, a family member is coming in trying to say, hey, how can I help? Or can I take over the payments? Or can I live there? Or those type of things.
Well, that's good though, because whoever's calling you, they already got it figured out pretty much. They know to contact the lender, so that's a plus. A lot of people think that they could just take over their family members' payments, and sometimes that's not the case. So, real quickly, very briefly, I'm going to give you some ways, right? So, the first thing you need to do is you need to check to see if the loan is assumable, and we're going to talk about that later. Check your credit. You're going to do a credit check. We're going to talk about that later as well. Connect with the lender. So, Erica, if they're already calling you, they already know what to do. They're calling the lender. So that is the first step. Then you got to go through the legal paperwork. And then we're going to talk about the benefits of a lower rate, because sometimes, depending on the market, the rates may not be lower. But in this market right now with these rates, what are the current rates right now, Erica?
We are actually pushing about 8% right now.
8%. Wow, y'all. So look. Also, if you don't want to take over your family member's mortgage, this right here is a way to negotiate a great offer. It's a way to negotiate a great offer right now, or to get lower payments if you are buying a home. So if you see a house that's currently for sale and that's currently on the market, this will also be a great tool to take over the seller's payments. And what's beneficial about this is, if the sellers have those nice rates that we had about 2 years ago, year and a half ago, those 1% and 2%, your payments would be a lot lower compared to these current 8% rates. So, all right. So we got the people who has a family member's loan that they want to take over. And also this is beneficial for the people who are currently in the mortgage market that's shopping for a home. Okay. So you got two ways. Great rates either way. But if they have higher rates, you probably just want to consider getting a new loan. So we're going to talk about that also. So let's talk about it. So Erica, can we take over all mortgages? If like, let's say if we wanted to buy a house, or if we wanted to take over our family member's mortgage, can we take over all mortgages? What's the first step should they do, like, whenever it comes to that?
So they need to check to see what kind of loan the family member has, because just like you said, not all loans are allowed to be assumable.
Yeah, the word is assumable. Okay. If you're ever doing your research, the word is assumable. Okay. Hit the like button, y'all. Hit the like button, hit share, because I'm sure we get this question a lot. Okay, Erica. So assumable is the word. Go on.
So then you want to see, once you see what kind of, how much, how much do they owe on this particular mortgage. So that's something that you will probably have to have the seller or your family member find out from their mortgage insurance company, from their, whoever holds their mortgage.
But pump your brakes though. What kind of loans are assumable? Thanks for
Usually
the
your
life,
government
y'all.
loans are going to be assumable.
Mm-hmm.
So your FHA, your VA are normally
Mm-hmm.
assumable loans. There are some conventional that are assumable, but you would
What?
have to, and those are usually like older loans, stuff like that.
Mm-hmm.
So that's not the norm these days.
Okay. So first thing you need to do is you need to check to see if it's assumable. Traditionally, you have FHA loans that are assumable.
Mhm.
A VA loan that's assumable. Uh,
Mhm.
what other loans are assumable, Erica?
Generally, that's it. There are sometimes you can find USDA that
Mm-hmm.
may be assumable, but there are income guidelines, there are AMI guidelines, which is the area median income.
Mm-hmm.
All of those are things that would need to be in place with a USDA, and those are usually old USDA loans.
And we're going to talk about that also. And you said in some cases, conventional, the old conventional
Hmm.
loans could possibly be assumable, right?
Right. Hmm.
So don't write it off, y'all. Don't write it off if it's a conventional loan. All right, so let's talk about it. So you said the loan must be assumable, right? So let's talk
Right.
about it. So FHA. So the first thing they need to do is make sure the eligibility, right? The assuming borrower
Yes.
must meet the lender's federal housing FHA credit and income requirements. And typically, assuming the borrower must occupy the home as a primary residence, Erica. So first step, what's the credit score for an FHA loan?
A credit score right now is 580 is the minimum credit score.
Okay. Okay. So they said something about income requirements though. Like what does that mean? What you talking about?
So as far as your income requirements, so you still have to be able to afford this house.
Okay.
So it's not a case where, just because they have a loan, you automatically can get this loan.
Okay. Okay. So all right. So is that where the DTI and all that stuff comes in and explain to
That
them?
is correct. Hmm.
Okay. Okay. All right. Did you say something about an MIP up front earlier? So wait, the lender's approval, because all lenders they have different guidelines, right?
That's correct.
Okay. And then you said something about MIP. FHA loans must have an upfront mortgage insurance premium. What is that?
So that's what protects the loan. So that in the event that you default on this loan, whoever the institution that lended you the money,
Mhm.
they make sure that they'll get their money back.
Okay. So, all right. All right. And but I need you to break this stuff down a little bit more. Pretend like I don't know. Explain this to the
Well,
people, to our
a
audience.
mortgage insurance premium is that's just what it is. It's the protection so that the lending institution will get their money back. So it's basically the government saying, "Hey, we're going to give you they're going to have to pay this additional insurance so that in the event that the borrower defaults on this
Mm-hmm.
loan, you're protected." So that's one of the reasons why, 20% down is not the norm anymore,
Mm-hmm.
just because, you have to have something invested in this house before you decide that you want to, they call it, you got to have some skin in the game.
But my question to you is when it comes to FHA loan, right? Whenever you get an FHA loan, you got to pay what,
Hmm.
3.5% down,
That's
right?
correct.
So when you assume it, do you have to pay that down?
You usually still have to have, there either has to be some equity in the house. There has to be, there's got to be something else there.
Okay.
So
So
you
what's
have to do
equity?
equity is the difference between what's owed on the house and what the house is actually worth. Now, a lot of times when you take over a seller's mortgage, then unless they're selling it for exactly what they owe on it, then you have to come up with the additional money. So if they owe $100,000 on it, but they're selling the house for 150, so even if you're able to assume that loan for the 150, for the $100,000, you still have to pay that $50,000. Now, whether
So
you're
how,
paying that out of cash or whether
uh-huh.
you get a second mortgage to do
Mm-hmm.
that piece of it.
Mm-hmm. So that's what it is. It's a second mortgage. Okay. So if there's a
Hmm.
difference, right? Okay. Because family members, a lot of the times, if you're taking over a family member's mortgage, Sometimes they may not charge you extra for the property a lot of the times, but you're going to have these sellers out here in this current market. Because again, to take over this mortgage and how to take over a payment for the sellers or people that's outside your family, they're going to be charging you more, right?
Right.
So sometimes with the family member, there may be something that's called equity on that property. And again, what equity is an invisible piggy bank. So over the years, as your family member they've paid down this mortgage, and this is the benefit of home ownership, they paid down this mortgage. The money's growing in the background. So they started with the $100,000 mortgage. They paid down on this house to about $50,000, but this house is currently now worth $300,000. You see what I'm saying? So that's the
Yes.
equity, and that's how much money you have left. And if you get this house from a family member, if they give you this house, or however you're working this out or whatever, you have all of that equity in that house. And many times with equity, and the benefit of having equity is you can take that money out, you can use it to invest in something else, you can go buy you another house, you can go. This is why generational wealth and home ownership is so important, because when you are renting, you're not getting any of this, and you may be lucky to get your security deposit back when you're renting. But whenever you own a home, you're building equity. You're getting that invisible piggy bank. It's constantly growing over and over and over and over and over. Okay, but I got off subject.
That is correct.
Yes, I get excited when you say.
Well, just to
equity.
speak to that,
Like,
like I just I just got off the phone with someone that I did a loan for just a few years ago, and she bought the house for $180,000. Well, now it says that her house is worth $270,000.
Yes, how
So
much was
now
it again?
She bought it for $180,000.
Mm-hmm.
Now it says that her house is worth $270,000.
Oh wow, that's awesome.
So it's
That's so awesome.
$90,000 worth of equity that she has in just a few short years.
Yes, y'all. Yes. So look, to the people out there who's thinking about buying, I know you don't want to pay these high rates right now, but these are some ways, some creative ways that you could do it. But even if you can't assume a loan, or even if you got to pay the higher rates, there are still some benefits in home ownership. It's there are benefits. All right. So
Well, for
we just
most people, that's how their net worth. For most people, that's where
Mhm.
your net worth is. So if you bought a house, let's say in 2000, and that
Mhm.
house was $100,000, now that house is worth $450,000. Now you're
Mhm.
talking about that's $350,000 that's added to your net worth by just living in a house.
Absolutely. Absolutely. Versus you kicking out all your money to rent. So
Right.
yes, absolutely. So the first one that's assumable is a FHA loan. Next, we're moving on to VA. What's
Mhm.
a VA loan? Is it for people only in Virginia, or what's a VA loan, Erica?
That is going to be for veterans or people who have served in the military. That
Mhm.
is a benefit there. Or it's also spouses of military, like widows or like of military members, is
Mhm.
also eligible for VA loans.
So VA loans, right? So okay. So if you're trying to take over a mortgage of a seller or a family member who has a VA loan, VA loans are assumable. And the first thing you want to do is, number one, you want to check the eligibility requirements, assuming the borrower must be qualified. They must be a qualified vet or a service member, right? Or have that loan entitlement. Good Lord. They must also meet the lender's credit and income requirements. Erica, what's the credit
Yes.
score for a VA loan?
So technically it has no credit score, but for most lenders, they still want you to have at least a 580.
580, y'all. 580. But VA requirements are 0, but the lenders, they get to add their own guidelines, right?
Mm-hmm.
So, all right, let's talk about the approval guidelines. So, in order to be approved for VA, what was like the DTI? How can I be approved for a VA loan?
So a DTI, there's not really a DTI requirement for a VA. So
Mm-hmm.
that's one of the ones where you basically put it in the automated system. And if the automated system says yes, then you can move forward. So there have been some where I've seen some where it was like 62% was their DTI. And that's
Mm-hmm.
higher than most because FHA caps out at 56.99.
And what does that mean? I don't know what that means.
So, sorry, what that means is that the income, your potential debt versus your income that you currently have coming in.
Okay. Okay. So let's talk about this then. So it says that your funding fee is typically the funding fee is typically waived for assumption transactions if the original loan if the original loan had this fee already paid. What is a funding fee?
A funding fee is a fee that a VA loans, they don't have the same closing costs that a FHA loan or any other type of loan has. So they have different closing costs. So there are some instances where the original veteran, maybe they were partially disabled or they were getting disabled um, from the VA. If they were getting some sort of disability, then that allowed them to not pay the funding fee. So if the funding fee has already been paid,
Mhm.
then the second person does not have to pay that. But
Awesome.
if the
Awesome.
first person didn't pay it, then it would be charged to the second borrower.
Okay. So all right. So we have a FHA loan that you can take over, or
Hmm.
if you are in this market and you're trying to buy again, we're not just talking about taking over like your family member mortgage payments. We're also talking about how to get some creative financing while you're out here shopping for a mortgage, because there are so many people out here who's refusing to buy a home because of the high interest rates. But
Right.
when you're out here shopping and if you see a home and if you're considering doing a loan assumption, have your real estate agent ask, are the sellers doing a loan assumption? Or make that as part of your offer. Ask those questions because you never know. Again, the current rates you say are almost 8%. Last
Right.
year we were doing 2% interest rates. So I'm just saying, it was a year before because it did go by kind of
It
fast.
was the year before we were doing two. Last year was like early last year was in the threes.
3 is better than 8. And I'm just
Right.
saying. So all I'm saying to you guys is you're out here shopping, you're allowing these high rates to hold you back. See, because I'm sure the sellers want to sell. And a lot of buyers, they're not out here really buying. And the homes are not going as fast as they were. Again, in some markets, they are receiving multiple offers. But again, last 2021, we would put a house on the market and it would sell within a few hours. You see what I'm saying? Compared to
Right.
now, you see a house sitting on the market for a week. If in 2021, if the house was on the market for a week, it was something wrong with it.
Hmm.
A week, you see it 30 days, is yes. So again, you guys, do not let these rates hold you back because this is a creative way for you guys to go in there and get this house with a lower rate. Like Erica said earlier, you do if there's a difference, you're gonna have to finance that difference. But hey, for now, assume this mortgage right here and figure out the rest. But anyway, USDA loan assumptions. So you said USDAs are not always assumable. Is that what you said?
They are not always assumable. There are some that you have to make sure that you meet the requirements, those type of things. So some of the older ones I find
Mm-hmm.
are, but there are some of the newer ones that they do not allow those to be assumable.
Oh wow. Oh wow. Anyway, so and USDA they also must approve this assumption as well. And you
Hmm.
must also meet the credit and income criteria for USDA also. So again, you can't just go and assume any loan, just like a vet, they got to assume a VA loan.
Right.
If the seller was a former vet, cool. That's a good way for them to sell their house. So you have an assumable loan that you can do also. So so let's go on, Erica. Some the pros of and cons of buyers doing these loan assumptions. Um,
Hmm.
Before I go down the list, can you think of any off the top of your head, girl?
Well, first of all, the assumable ones are a lot of times they can get that lower interest rate. So if you can
Mm-hmm.
find somebody with a 2 or 3% interest rate that is willing to let you assume their loan versus 8%, even if it's for just part of the mortgage, that is a
Mm-hmm.
game changer. That's
Right,
a
right.
lot less money that you're going to be coming out of pocket with. But again, you have to figure out how to pay for the rest of the house, whether that's, now I got to come up with $50,000, or, I have to find a lender that's going to allow a second mortgage.
Mm-hmm.
So, or to see if the original lender will do a second mortgage for that property.
Absolutely. So that's the pro. You have favorable loan terms. Assuming it, you can get lower interest rates. The next thing is a simplified process. Loan assumptions can simplify the home buying process. According to this, there's fewer paperwork. Is that true, Erica?
So you don't quite have as much paperwork, and it's really
Hmm.
only like a form or two. However, I will say I know we're talking about pros right now, but you do
Hmm.
need to remember that sometimes it may take longer to do an
Yeah.
assumption than it would to do just a regular mortgage.
Absolutely. And one of the cons, it may take a little bit longer, and it's also limited availability. So not all loans are assumable. We did say that a
Right.
thousand times
Hmm.
already. But all loans are not assumable, and those that are may have specific eligibility requirements. Again, you may not meet those income requirements or those credit requirements or the DTI requirements, right?
Or you may not be. So even though they may have a VA loan that is assumable, if you're not a veteran, then you don't qualify to assume that loan.
Absolutely. Okay. And lack of negotiation. So buyers, they have little control over the terms of the existing loan, and they must accept the loan terms and conditions, which may be as favorable as the current market. Okay. So, and that's for the buyers. There are some cons for the sellers. Also, it may make your property, the pros is, it may make your property more attractive to buyers as it allows them to inherit a favorable loan. It's a faster sale. The assumption process can lead to a quicker sale as it simplifies financing and reduces some of the hurdles associated with the new loan, which is a plus, almost kind of like cash. Sounds like cash in a
Right.
way. Lower transaction costs. The seller can save on closing costs. They don't need to originate a new loan and pay for appraisals or go through the underwriting process. So that this is for the sellers. But some of the cons are continued liability. So sellers must remain partially liable for the loan even after the assumption. Is that true?
Because sometimes it's tied to, like, especially like with a VA loan. Well, it was tied to their entitlement, all of those type of things. So sometimes they may still have some responsibility. So what happens if the second person defaults on that loan? Well, you had the loan to begin with.
Oh, that's crazy. Yeah, it says if the assuming borrower defaults, the original borrowers may still be held responsible for the remaining debt. That's
Hmm.
crazy. Potentially lower sales price. While an assumable loan can attract more buyers, it might also result in a low negotiated sale price. That is so true. As buyers may expect a discount to compensate for the favorable loan terms, VA loan entitlement considerations for a loan, the seller VA loan entitlement may remain tied up in the property until the assuming
Hmm.
borrower refinances or pays the loan off. So there you go. Some loan restrictions. Sellers with government backed loans, which is the VA, FHA loans, with government backed loans, may need approval from the government agencies overseeing the loan program. So
Right.
I know I did have a buyer one time. He wanted to do that. But the agent pretty much told her seller, don't do it because she said the loans, assumable loans, don't always close. And this is why, for me, after that situation, I did go out and I look for companies, what companies do loan assumptions. I did look into the newest one that just kind of came about was Rome, but I discovered that they don't do it in North Carolina. So you
Right.
definitely, when you're out and you're looking, you want to see if they do it in your state. But it is a company, that's all they do. They do assumable mortgages. It's called Rome, ROAM. And some other companies that I looked up. Again, I haven't used any of these companies, but it's one that's called Service Link. Um, it says a mortgage that is called Service Link. One is called Mr. Cooper. It's formerly called Nation Star Mortgage. I have
Hmm.
one that's called Loan Care, Loan Assist, and Assumption Assist. Also, believe it or not, your lender service department, they may be able to do it also. And also, how about Erica? Can somebody call you for a loan assumption?
They can call me for it, but it also you want to see what like who are they financed with already.
Mm-hmm.
So
And
just
for
like a FHA number stays with the house. So sometimes sometimes you can do a different company, but it just depends.
And for the people that just tuning in, we're talking about loan assumptions today. Right now we have these crazy mortgage rates. They are ridiculous. They're like 8%. And we're just talking about some creative ways that you could actually go out. You can get a loan. You could assume someone's own mortgage for about 1% and 2% or their previous interest rates if it's lower than the current market. Also, for the people who lost a family member or has a family member that want to move and don't really want to sell that house, this is the route you should go to take over their mortgage payments. And the word for that is a loan assumption. It's called a loan assumption or assuming a loan. And
And Jesse Lynn, I will say another instance where you have a lot of people kind of assuming a loan
mhm,
is that as you know, we have a whole baby boomer population that is aging, and
mhm,
a lot of times they may be moving to senior care facilities, things like that. So then
mhm.
that leaves their current residence available. And so, yeah, a family member or someone will come in and take over the payments, for that.
Absolutely. Absolutely. So I had a call about a reverse mortgage. I get that a lot, and a
Hmm.
lot of people don't really understand, what a reverse mortgage is and how that works, especially, when it comes to your seniors or whatever. So explain to them what a reverse, I know it's not on our topic for today, but what's a reverse mortgage for the
A
seniors? I'm
reverse,
always throwing stuff out for the seniors. I got to take care of them,
yeah.
girl.
So, a reverse mortgage is where they allow you to not pay the payments as
Mm-hmm.
far as, and then with for the exchange of, then that company then gets a lot of times gets the equity in the house. So
Right.
sometimes if you have enough equity in the house when you start the process, then they will pay you a monthly payment.
Mm-hmm.
But and that basically says that you get to live as a senior, you get to live in that house. You have to be at least 62 to take advantage of this, but you
Mm-hmm.
get to live in that house until you
Mm-hmm.
don't anymore. And once it no longer becomes your primary residence for a certain length of time, then I mean, that's not like, hey, I'm going to the nursing home for 10 days, I'm gonna lose my house. It's
Mm-hmm.
usually at least a year. Once it's no longer your permanent residence for a year,
Mm-hmm.
then that money has to be repaid back, whatever it is that they gave you.
Oh, but the question is, do you have to lose the family house? What's the
You don't have to
process?
lose it back. You just have to give them their money back.
Right. And sometimes, it may require us to sell that property. And a lot of people don't understand that they don't have to allow that property to go into foreclosure to the lender. They could sell that property or do
Hmm.
whatever they need to get that money back. Because sometimes, families, they only borrow about $50,000 or something like that. So, but you don't have to allow that property to go into foreclosure, or it doesn't mean that that prop you get to lose the equity that we were talking about earlier in that property. And equity is the invisible piggy bank. You can sell that property and you can still get the money for that home. So do not let that property go into foreclosure. And the longer after that time is up, the longer you wait, let's say if they passed away or something like that, the longer you wait, the more interest is going to build up.
Hmm.
So you want to go ahead and start the process as soon as possible, because the more you wait, the more interest is going to build up and the more equity that you're going to lose. Okay. So but let's go back to the loan assumption. So again, earlier we said for the loan assumption, the first thing you want to do is number one is to check to see if that loan is assumable. How do you check that again, Erica, very quickly for the people that's just tuning
You
in?
have to check with the original lender. So usually the seller or
Mhm,
the whoever's on that
mhm.
on the mortgage would need to check with the lender that they have right now.
Okay. Number two is a credit check. It's almost like buying a house, y'all. So a credit check. All right. What's the minimum credit score that you need for those loans, the assumable loans?
580
And what loans are
government
assumable?
loans,
Uh,
580 for government loans.
580, you guys. So is the loan assumable? Check, check. Do I have a 580 credit score? Check, check. All right now. So now you need to connect with the lender. When you connect with the lender, you're starting the what process? Are you going all the way through that pre-approval process? I'm sure you are, but Explain what
You
you
do
do
have to go
when
through
they
the
call you.
pre-approval process because you do have
Mhm.
to make sure that you are qualified in order to purchase this home. Because just because you have a 580 and the loan is assumable does not mean that you can automatically just assume it.
All right. And then the last thing you want to do is you got to go through the legal, well, not the last, the legal paperwork. There's some paperwork involved in a mortgage assumption. So just make sure that you complete it and it's accurate. And then the best part is you get the lower rates. That's it. That's all we
Right.
have. So, audience, do y'all have any questions about how to assume these loans, what to do, and how the process works, or what? Erica, you got anything you want to add, girl?
No, well, I would say assumable mortgages are a good option if you can get them. But you do just want to make sure that you know all the ins and outs, that your lender explains everything to you so that you know what's really going on with this process.
There you have it, you guys. There you have it. All right. TikTok, Facebook, do y'all have any questions? Y'all got any questions for us about how to get a lower rate in this market and how to take over your family member's mortgage if you needed to? How to keep the house and the family, because it happens a lot. You got a lot of people who don't want to get rid of the family land or the family homes. So this is what you do. All right. If y'all don't have any questions, Facebook, we are out. TikTok, y'all want to talk? Y'all want to talk about the home buying process? What y'all got going on over there?
I don't see any questions.
All
But we
right, y'all.
appreciate y'all tuning in.
Thank y'all for tuning in. We appreciate. Somebody got a comment right there, Erica. See, your eyes ain't moving fast enough.
No, it just
All
popped
right.
up.
They said explain what happens if there's an outstanding balance. As
You
far
are
as what?
responsible. You're responsible for the balance either way. So whether it's an assumable mortgage, you are responsible for that balance. And if you're talking about a reverse mortgage, then you're also responsible for that balance.
So which one are you referring to? Are you referring to the assumable mortgage, or are you referring to the reverse
Reverse mortgage.
the reverse mortgage? But yes. But and that's the point. So if it's an outstanding balance, that's the point of the assumption. Because if there's no outstanding balance, you don't really have anything to assume. I mean, the other stuff is just some simple title work. You just go down,
Right.
just transfer the name over. But up until you pay that mortgage off, you technically don't own the home. The bank, they have ownership in the property. It's considered a lien. You have a lien on that property, right?
Right.
Up until that mortgage is paid off. So, yeah. All right. All right. They didn't ask that question again, unless we're moving slow on the. I forgot it is a few seconds behind. All right. So the assumption, if the family members want more. Oh, that's a good question. Yes. Erica, tell them what they need to do if they want more. So TikTok, if the home is more than the balance that they owe on the property. So if the home they only owe $100,000 on the property, but the family member is selling the home for $200,000, or the
Then
seller
they
is selling
either
the home
have
for
to
200,000.
come up with that balance through like their own cash or that type of thing, or sometimes you can find a company that offers a second mortgage that's willing to be a second lien holder on the account, and then you can still borrow that money.
And is the process the same as a traditional mortgage? Like if they're applying for a traditional mortgage for the
It's
second
very
loan.
similar. It's very similar, but they
Mhm.
just have to make sure that that company will do second liens, because a lot of companies don't do second liens. They're like, if I'm not the first lien holder, then that's going to be too risky.
Right. So that company that I was telling you guys about is called Rome also. That's what they do. A few of those companies, that's what they do, strictly what they do. And if there's a difference, they're going to make sure you get the second loan. Like I said, if Erica does it, give her that call as well to see if that's something that they can do or whatever. But there are companies out there that does that specifically, loan assumptions. Okay.
Yep.
So yeah. All right. Y'all got any more questions? Erica, we got to keep in mind that it's like a delay on our end. So when we
Right.
talking,
Right.
they not typing, they typing, and we got to keep up. Y'all got any
Okay.
more questions before we go? That was a good question, by the way.
Well, if so, definitely give us a call and we'll be happy to try to help you.
Absolutely. All right, y'all. All right. Thank you guys so much for tuning in. For those of you guys who don't know me, my name is Jessie Lynn. I'm a triangle realtor with A to Z Realty. You can reach us at 919-818-9854. Miss Erica Batts, loan officer.
Hey, and you can reach me at 919-608-7916, or you can reach me at ericabats.com.
Y'all can reach us in the Homebuyers Clubhouse at www.thehomebuyersclubhouse.com. Y'all can find us on Facebook, on our page, and in our private group at Homebuyers Clubhouse. You can find us on YouTube at The Homebuyers Clubhouse. TikTok, you know where to find me. Facebook, we'll talk to you guys later. Bye-bye.
Bye.